Picture this. You retire at 65, you've saved $2 million, you feel great about where you land. Then you turn 73, and the IRS sends you a letter, not asking, telling you to withdraw $91,000 from your 401k this year. You don't need the money. It pushes you into a higher tax bracket. Your Medicare premiums just went up, and there is nothing that you can do about it. That's not hypothetical. That's the math for most high net worth retirees, and it was locked in the day they made their first 401k contribution. Here's the part no one told you. There's a window to change this, but it closes at 73, and most people find out after that window is already shut. I'm Dustin Rudolph, founder and president of Legacy Ascent Wealth. In this video, you're going to learn exactly how the 401k trap works, who's hit the hardest, and specific moves that can protect your retirement income before the window to act closes. We're going to walk through two real families, same savings, same market, same Social Security, who end up in completely different retirements because of one decision made before 73. So let's get into it. Most people think their 401 saves them on taxes. It doesn't. It delays them, and actually your taxes are higher because that deferred growth grows your account balance. And that distinction, deferral versus elimination, is the entire game. And most people's conversations blow right past it. Here's the honest version of what happened every time you contributed. You and the IRS made a deal. You said, I'll skip the tax bill today, and they said, fine, but we'll collect later at a rate we haven't decided at yet. You don't own 100% of your 401k. You own what's ever left after the future tax bill. You just don't know that exact number yet because it depends on future tax laws. And for most of your career, that deal made sense. You were in a high tax bracket, the deduction was valuable, deferral was efficient. But here's what happens in retirement that breaks the math. 3 income streams switch on at almost the same time: Social Security, investment dividends, and required minimum distributions. None of them ask permission, but all of them are taxable. Stack those 3 together, and something called bracket crowding happens. You're retired, your income dropped, but your taxable income didn't, because the IRS is pulling from your 401k, whether you need it or not. And there's a second penalty most people never see coming. IRMAA, income-related monthly adjustment amount. If your combined income as a married couple crosses roughly $212,000, your Medicare premiums jump automatically in tiers as much as $5,000 or more per year. So you have higher taxes and higher Medicare costs, both triggered by a 401k that did exactly what it was supposed to do. That's the trap, and it was built into the structure from day one. Here's why this matters right now. In 2025 and 2026 specifically, starting in 2026, if you earn over $145,000, the IRS is requiring your 401k contributions to go into a Roth. Not traditional, Roth. A lot of people hear that and think that's worse, I lose the deduction this year. Flip it. If you're already heading toward bracket crowding and IRMAA exposure, adding more money to the pre-tax pile isn't efficient. It's pouring fuel on the fire. The government just forced you to do something that actually helps you. The question is whether you understand why. If your advisor hasn't walked through what this means for your specific retirement income picture, that conversation needs to happen now. Not at 70, not when the RMDs start, now. Let me show you exactly how this plays out. 2 couples, the Garcias and the Kellys. Same age, 62. Same total savings, $2 million. Same Social Security projection. Same investment returns going forward. The only difference? How they held their money. The Garcias did everything by the book. Maxed their traditional 401k every year. Full $2 million sitting in pre-tax assets. Their advisor called this disciplined, and it was. The Kellys, on the other hand, did something different. In their early 60s, before RMDs kicked in, while their income was temporarily lower, they converted $800,000 of their 401k into a Roth spread out over a decade. At roughly 22% average tax rate, that conversion costs them approximately $176,000 in taxes. So the Kellys didn't start with $2 million to work for them. They started with about $1,824,000 split as $1.2 million pre-tax and $624,000 in Roth after the tax cost. That $176,000 is real money. It hurt, and it was absolutely intentional. Because fast forward to 73, both portfolios have had 11 years of growth at a conservative 5% average annual return. The Garcias $2 million pre-tax has grown to approximately $3.4 million. The Kellys $1.2 million pre-tax has grown to roughly $2 million. Their $624,000 Roth has grown to approximately $1.07 million. Total portfolio just shy of $3.1 million. The Garcias have about $330,000 more on paper. That's the real cost of the conversion strategy. Don't let anyone tell you otherwise. But here's what that $330,000 difference doesn't show you. The Garcias $3.4 million has a tax bill attached to every single dollar. They just don't know the exact size yet because it depends on future tax law and how much the IRS forces them to withdraw every year. The Kellys already paid part of their bill at rates they controlled at years they chose. Now here's where it pays out. The Garcias opened their RMD letter at age 73. With $3.4 million in a pre-tax account, the required minimum distribution is approximately $127,000. Add Social Security, both spouses combined at $64,000, add about $14,000 worth of dividends, total gross income is $205,000. After the standard deduction, roughly $178,000 is taxable. Federal bracket solidly in the 22%, pushing in to 24% tax rate. Now their IRMAA status above the second threshold, Medicare premiums up $4,200 this year on top of the standard costs. Tax bill on that $127,000 RMD alone, approximately $28,000 to $31,000. Money they didn't ask for, money they may not need, gone. Now the Kellys. Their pre-tax account grew to $2 million. RMD at age 73, approximately $75,000. Add $64,000 of Social Security, $14,000 of dividends. Total gross income is $153,000. After the standard deduction, roughly $126,000 is taxable. Federal bracket 22%, not even close to that 24%. IRMAA status still below that first threshold. No surcharge. Tax bill on the RMD approximately $16,000 to $18,000. Year one difference about $12,000 to $13,000 less in taxes for the Kellys. But that's the starting point. Now let's look at what actually happens over time. Here's what most people miss. The gap doesn't stay at $12,000, it grows. Every year, the Garcias pre-tax account keeps compounding, which means their RMD keeps climbing. The IRS calculates your required minimum distributions based on your account balance and a life expectancy factor that shrinks every year. Bigger balance plus shorter life expectancy factor equals a bigger forced withdrawal every year. At age 78, the Garcias RMD is pushing $160,000. At age 83, it's closer to $190,000. By age 90, if the account has continued growing, their annual RMD could exceed $220,000. They're being forced to recognize over $220,000 in taxable income at age 90, whether they need it or not, on top of their Social Security and whatever dividends that they're getting paid out as well. They're being forced to take an additional $220,000 on top of their Social Security and any other income, whether they need it, whether the market is up or down, whether they want it or not. Their tax bill at that point isn't $28,000. It's closer to about plus or minus $60,000 a year just on the RMD. IRMAA exposure has followed them in the same way. Medicare surcharges have compounded alongside the tax bill for nearly 2 decades. Now the Kellys at age 90, their pre-tax account has been drawing down through smaller RMDs for 17 years. The balance is lower. The RMD at age 90 is approximately $95,000 to $105,000. Their Roth, which has never been touched because they didn't need to, has been compounding at 5% at 28 years. That $624 they converted at 62 is now worth approximately $2.4 million tax-free completely. So let's run the honest cumulative math. From age 73 to 90, 17 years, the Garcias pay an estimated $600,000 to $700,000 in federal taxes on forced RMD income alone, not counting state taxes, not counting IRMAA surcharges, just federal income tax on monies the IRS made them take. The Kellys over the same period pay an estimated $280,000 to $320,000 in federal taxes on their RMDs. The difference, roughly $350,000 to $400,000 in cumulative taxes over 17 years. Remember that $176,000 conversion that hurt so much at age 72? By age 87, the Kellys in this example have recovered it entirely in tax savings alone. Every year after that is pure upside, and the Roth is still sitting there, untouched, growing. Now here's part of the conversation that almost never gets discussed. Both couples pass away. The kids inherit the accounts. What happens to the Garcias kids? They inherit a traditional pre-tax IRA, and under current law, specifically the Secure Act, non-spouse beneficiaries must fully withdraw inherited traditional IRAs within 10 years. Think about where the kids are. They're likely in their 50s and early 60s. They're in their peak earning years. They may be in the 24% or 32% brackets already if tax brackets don't go up. Now add a forced inherited IRA distribution on top of that. Every year for 10 years, if the Garcias pre-tax account is worth $1.5 million at time of inheritance, the kids are pulling out $150,000 per year in fully taxable income on top of their own salaries at 32%. That's roughly $48,000 per year in extra taxes. Over 10 years, almost $500,000 in taxes on that money that has already been taxed once at the estate level. The Garcias have spent their whole lives building wealth for their family, and the IRS is taking nearly a third of it on the way out. Now what happens to the Kellys kids? They inherit a Roth IRA. Same 10-year distribution rule applies, but here's the difference. Roth distributions are tax-free. The kids pull that money out over 10 years and owe nothing. Zero federal income tax, and during those 10 years, the account is still growing tax-free inside the inherited Roth. If the Kellys' Roth is worth $2.4 million at inheritance, the kids receive the full $2.4 million, not $2.4 million minus whatever bracket that they happen to be in for that decade. The full amount, tax-free, and if they pull it out over 10 years, that's only growing to a bigger pie. So let's put the whole picture together. The Kellys paid $176,000 at age 62 to convert to the Roth. In return, they got $12,000 less in taxes in year one at age 73. Roughly $400,000 less in cumulative taxes by age 90. A Roth account worth approximately $2.4 million passing to their children completely tax-free, zero IRMAA surcharges for nearly 2 decades, the ability to spend $150,000 in any given year without a tax consequence. The Garcias paid nothing at 62 and spent the next 30 years paying for it. That is what the $176,000 decision looks like over a lifetime. Here's the bottom line. Your 401k did its job. The problem is that most retirement plans stop at how much did you save and never ask, how will you actually draw this down without giving a large portion back to the IRS and leaving the rest to your kids to give it to the IRS back too? The Garcias saved $2 million. So did the Kellys. By age 90, the gap between them isn't their portfolio size. It's the $350,000 to $400,000 in taxes paid. It's 2 decades worth of IRMAA surcharges. It's nearly $500,000 taken from their children on the way out. All of that was predictable. Almost none of it was inevitable. The window to address this is between retirement and age 73. That's it. After that, the RMDs start and your options narrow fast. There is no undo button. If you have $1 million or more sitting in pre-tax retirement accounts and you don't have a clear picture of what your future tax bill actually looks like, that's the problem we're solving right now. Not eventually, now, while you still have flexibility to do something about it. We'll map out your RMD trajectory, your IRMAA exposure, and show you exactly where the opportunities are to mitigate what's coming before the window closes. Click on the link below to schedule a conversation. It's free, and it might be the most valuable hour you spend on your retirement this year. I'm Dustin Rudolph. If this video was useful, subscribe and share it with someone who's still building their 401k without this picture in mind. I'll see you on the next one.